All right, Kate. Good. Thanks, Ethan, for the quick introduction. And of course, welcome everyone to today's session over here. Right. So, yeah, so again, quick one before we get started. Just make sure that you're being present today, okay? And if you have any questions, what I would strongly recommend is to just drop your questions directly into the question tab first. As you know, we go through, you have some questions pop up, just immediately put that in case you kind of forget, like, what you want to ask at the end of the session, right? But the flow over here is I'm gonna go through the content that we've prepared. Then at the end, closer towards the end of the session, we have allocated some time for Q&A. That's where I'm going to look into the question tab, okay, and answer as many questions as we can that you have actually put it in, okay. So very quick one here as well, reminder on the disclaimer aspect. Of course, I'll be sharing with you the strategies, the approach that I use to trade the markets, okay. I just want to also stress that, of course, all those are just for educational purposes and they're coming from my own personal opinion and experience. It doesn't directly constitute to, any form of investment advisory or trade advisory. Okay, and of course, trading, as mentioned by Ethan, involve risk as well. So just make sure you're aware of all this, in terms of like the disclaimer side of things, okay? Now, before I even jump into like the strategy that I use, the approach that I use to trade the market and analyze the market, I thought it's also important to also highlight, this year's result, so that I want you to be able to kind of participate and be part of today's session here, knowing that what I'm sharing with you, okay, is actually something that is very practical. It's not some, just theory stuff and concept, but in fact, it's something that you can take it from today's session and directly apply into your own trading and start to see some results, right? Okay, so that's my my results since this year to date, right? You can see from January all the way into October. Of course, that's when we are preparing this like that. Okay, that's where the slides were actually prepared, right? And this is another account that I have, right? You can see from January all the way to October as well. So the average performance, again, is not something that you would look at, double-digit returns every other month. Okay, and I strongly believe that you can do it. You can actually achieve double-digit returns. However, you need to be prepared to take massive amount of risk, right? Which is not something that I would say you want to actually go through that route, right? Because if you're taking massive amount of risk, psychologically, it's not going to be easy for you to handle, right? Especially when you hit a drawdown. And if, let's say, you don't control it well enough, okay, you might actually wipe out a good portion or even an entire account of yours, right? So what we are striving over here is not about the fast gain, but it's more towards the sustainability as well as the consistency of kind of like gaining some profits off the market, right? And as you start to do it consistently and sustainably, that's where you're able to compound the entire results. And I would say in a year, if today you're able to trade, comfortably, and able to achieve, a consistent results of about maybe 15 to 20% a year, I think that's pretty fantastic. Okay, compounded over years, right? So that's something I just want to very, very quickly put off, so that you know that what we are sharing over here are not things that are just based on theory. Okay. Now, there are some objectives that I would like to achieve by the end of today's session. Number one is to highlight and share with you, right, what are the 3 key factors to contribute to a winning strategy. Now, I'm going to share with you my approach, but at the same time, I also want to give you the framework that I have in my approach, in my strategy, so that in the event, you realize that, oh, not every piece of my strategy fits into your style, fits into what you're liking. You can actually still use the framework to craft and create your own strategy, right? Or kind of like fine tune it to fit into your personal style. The reason for this is because every trader, or I would say every person, would have a slightly different personality. Okay, some people prefer shorter term, some people prefer longer term, some people prefer certain sets of indicators, some people prefer, purely price action, technical analysis, etc. Right? There are just so many ways to actually trade and analyze the market. And there's no such thing as like the holy grail or the one best way, right? But what I strongly believe is there's actually a framework that a winning strategy would need to have, right? And that's where this three key factors is something that through my years of experience and learning from the market, I believe that every winning strategy will need to address these three key factors, right? And that forms the framework that I want you to take away by the end of today's session. Okay. Now, using my technique, I'll also be sharing with you how you'll be able to identify high probability direction to focus. Okay, whether looking at a chart, looking at instruments, do you want to be looking at a buy side of things, or do you want to be focusing on the sell side? Okay, or sometimes the market is just not clear, and then you just want to be on the sidelines, right? Not taking any direction or what we call directional bias. You just be neutral. Okay, and of course, I'll also be sharing with you the method that I use to pull the trigger. Okay, knowing when to execute, when to enter, what is the method to get involved in the trade, how do you manage it, how do you get out, where's your target and stops, etc. These are the things that we'll be covering as well. Okay, but again, I want to just stress, it doesn't necessarily mean it's a plug and play, right? Because what works for me may not necessarily work for everyone. But what you want to do is to take away the essence of things, right? And then fine tune it to your own liking. Okay, so I'll be sharing with you how to execute trades, etc. And of course, the final objective at the end of today's session is to really give you that confidence, right? I can't guarantee you a certain percentage of profits, okay, by the end of today's session, but I do hope that by giving you and helping you to equip, okay, yourself with the techniques, with the knowledge, with the skill sets, you'll be able to gain the extra confidence to bring it to the next level in terms of your trading, okay? And that's really what I want to achieve today. Okay, so let's start off by giving you a quick overview of the framework, okay? And this framework over here, just now I mentioned there are three factors. They're basically over here. On the screen, you can see number one is direction, okay? And then we have some arrows there as well, right? And then it goes over to the time aspect and then the price point. And then in terms of price and direction, you can see there's actually a two-headed arrow. Okay. Now, oftentimes what we do is we start off by the direction first, right? I mean, that's the easiest to actually start in terms of your step one of your analysis process, right? You want to immediately look at the chart, or even, if you don't look at the chart based on some fundamental or economic data, you want to first establish the focus of your direction. Okay, we call that directional bias, right? If you don't have a clear sense of direction to focus, then there's no trade, right? Because you wouldn't need to spend any effort or time to go and analyze it further because you have no high probability direction, okay? So we always start off with the direction, okay? And once you have established a directional bias, then that's where you need to proceed over to time, right? So that's where the arrow is, right? Timing here is all about when to enter, when to exit, what price to enter, what price to exit, right? It's all about that entry and exit, right? And later we'll share with you this term called setups, right? So setup is basically what are the sets of conditions and criteria you need in order for you to exit or enter the market, okay? And then once you have your sense of direction, you have the directional bias, you have your setup in place, you need to then again cross-check to price, okay, or what I call context, right? And the idea of this is, of course, at certain price point or certain context in the market, you may not want to still take the trade, right? You may have a clear sense of direction, you may have the setup for you, but if the trade does not make sense, the risk to reward ratio maybe is not worthwhile, okay, or even the risk to the effort, okay, to reward potential is not worthwhile, then you may not want to take that trade, right? So that's the whole concept on context, right? That's what I meant. Okay. Now, sometimes where price is and the context of the market will also give you some directional bias, right? For example, if the price is very near a significant, yearly kind of resistance, naturally you don't want to be buying into it, right? You will be wanting to look for that reversal soon, right? And that context would help frame the directional bias for us. Okay. So this is the overarching framework for every strategy, right? And I strongly believe doesn't matter what technique you use, it can be based on, like for me, Elliott wave principle, you can be based on certain indicators, you can base on price action, you can base on simple support resistance, or fundamental base driven, any strategy, I believe, will need to have this 3 component, right? Determine the direction of bias to focus, which means the high probability direction, the timing to execute and exit your trade, and last but not least, the context, right? The risk to reward ratio perspective. Okay. So with that said, right, I just want to very quickly give you a visualization of why is this 3 component important. Okay. So imagine today, if you get involved in a trade, overall your direction is right, but you did not execute your trade at the ideal timing. Okay. What would it likely be, right? Or today, if you kind of get in the wrong direction, but somehow, you got lucky, you got in the right time, how would that trade be, right? So I just want to give you some visualization of things, right? And of course, if you can get the both direction right, but the context is not at the best price, how would your trade end up to be, okay? So let's talk about first one, right? So imagine today you kind of stuck to the right direction, right? Which means that you analyze the chart, like in this case here, right? You look at the chart and then it's clearly an uptrend, and then you say, okay, let's buy, right? You're basically following the trend, right? So there's a high probability you're going to make it, okay? Because the overall trend is up and you're looking at the buy side of things. You have a high chance of winning, right? The odds is with you. However, if the timing is not ideal, okay, imagine you're buying here, right? When the price is literally going up and you are buying at the top. What happens is if the price pulls back, okay, it's technically still in an uptrend, but if you bought it at the wrong time and the price pulls back, you'll be actually suffering some drawdown, or in fact, some traders may even exit the trade with a loss, right? Because that pullback may have tagged their stop loss and things like that. Okay, so psychologically, how would you be feeling, right? And what's worse is, imagine if after that pullback, the market gets you out and then it immediately go back in the direction that you have actually made, right? Which is eventually you could have made money, right? But the course of the timing, you actually lose first, right? So this is the part where I want to share with you. I strongly believe if you have been trading in the markets, you may have encountered some experience like that, right? Similar sort of. And this is a classic example of getting the direction right, but executing the trade at not the ideal time. Okay, I mean, we definitely can't be perfect, right? I mean, you won't have a strategy that is always going to give you the direction right and the timing right, okay? But you want to work towards a technique that is able to at least minimize the possibility of getting the right direction right and the timing wrong. Okay, so this is a good example of why timing is important. Okay, this is another example to visualize the part where you don't really get the direction, but somehow you got lucky, and what would be the outcome. So this example here, you can see the market is essentially in a range, right? We have the top and the bottom. The price is basically bouncing up and down in the middle of it. Now, typically in this kind of situation, I won't take a trade, right? I would even say, I would say majority of traders probably won't take a trade, right? Because we're in a right smack in the middle of the range. It's not like we are close to the top or the bottom range. We can trade the bounces of the range, but this example here is literally in the middle. Okay, so I would say most traders would not actually kind of like take a trade, right? Because the odds of it is almost like 50-50. Okay, but let's say you don't really care about direction, but somehow you manage to capitalize on the timing, right? So this here, you may be ending up being profitable whether you are buying or selling, right? Because if you bought it and you sell it, you can make money. However, this kind of trade outcome is something that's very hard to duplicate, right? You may be lucky once, you may be lucky twice, but can you really extract the elements that help you gain a profitable trade? Probably not, right? Because in this case here, how would you find out elements that determine whether to buy or sell, right? It's very, very difficult. So this kind of trade results are where I say, you got lucky, okay? But you are not able to repeat the process, and therefore it cannot be consistent, okay? So this is what we call luck, right? So you may get the direction wrong, or you may not have a direction bias, but you can still make money of it if your timing is right? So that's luck. Last example, right? Visualize this. Today, the market is coming down, strong momentum, right? Naturally, you'll be looking at sell trade, okay? And let's say you just decide to sell it, okay? However, if today you take a look at the left-hand side of the chart, you realize that, oh, that's where the market actually made a decent bounce, right? It came down, it bounced back up. So that's a pretty significant support zone, Now, if you're selling here and you're looking at profits just around that support zone, then you start to realize that, oh, okay, maybe your effort to reward is not that great. Okay, I mean, every time you take a trade, right, it's not just your capital at risk, but you would also need to put in the commitment in terms of your psychology, in terms of your effort, in terms of your mental capacity as well, right? Because if today you are taking like 3 trades, right, each trade will take out a bit of a mental capacity as well. Right. So as we are assessing situation and assessing trades to take, right, the other thing we consider is context, right? Is it worth taking the trade? If I take this trade and I need to put in the effort to manage and monitor this trade, I may miss out on something better, right? Because again, I mentioned there's a mental capacity, right? So do take note of all these elements, right? And just want to put it up front over here to illustrate and help you visualize some examples so that you know why these 3 elements is essentially so important. All right. So with that said, I'm going to share with you my approach, my way of determining the direction, determining the timing, as well as the context perspective. Okay. Now again, I just want to remind everyone, okay, this is not a holy grail. This is not something that you just plug and play. Because what works for me may not necessarily work for everyone, okay? But as we go through how I do it, I want you to be more importantly, right? I want you to be able to extract the essence so that you can then duplicate that for yourself, okay? So when we talk about directional bias, there are generally 2 methods that we can use to analyze and determine the direction, right? One is the fundamental perspective or the macro perspective. So that's including, if you're looking at like FX currencies, okay, you'll be looking at what the central banks are doing, how the economy is doing. If you're looking at perhaps on the stock side of things, right, you have like your fundamental companies, how the company is performing, the businesses, you have like top-down approach as well. You have the global macro environment, you have the industry performance, how the industry is performing and things like that. So those are fundamental. Okay, and then we have the technical, right? It's basically looking at the charts. Okay, so what's the purpose of this, right, in terms of fundamental as well as the technical? Okay, fundamental over here, the main goal from my understanding, right, what I believe is that it always gives you a big picture perspective. Okay, the macro and the fundamental give you a backdrop. Okay, so it helps to create that confidence, that conviction in the trade. It gives you an overall direction to focus, but fundamental has a downside. Okay, it can't really give you timing. Okay, I've never seen a fundamental trader trade short term. Okay, because short term, the precision of your entry and exit is very important, right? But if you're looking at long term, big picture perspective, I think that's a little bit easier to determine the direction. Okay, so if you're more like investing, then of course fundamental becomes very, very crucial. If you're more of a short-term trader, then fundamental becomes more of like a backdrop information. Okay. So in the context of FX, just I mentioned, fundamental includes understanding what the banks are doing, the monetary policies, what are some of the economic performance, as well as the short-term risk sentiment, right? Is there any sudden market uncertainty that would shake, the market going into risk on and risk off, etc. Okay. So those are the context on FX. And in the context of stock market, we look at macro liquidity, right? Things like, are the Fed generally in a hiking process or what we call a tightening process, or is it in the easing process? That would have a impact on the global macro liquidity. Okay, then of course we look at sector rotation, we look at seasonality, and then we go down and look at individual companies' performance. Right? Okay, so that's general what fundamental macro is. Right? Now my approach is that I understand the macro, I understand the fundamental, I do look at them, but majority of my trading decision comes from technical analysis, right? Because shorter term, like trading, fundamental to me don't really play a significant role. It just simply gives me that extra layer of conviction, right? If the fundamental and the technical align, great, high conviction. If the fundamental doesn't align with the technical, I would still follow the technical, but I'll be a little bit more careful on that. Okay, so that's my general approach. Okay, and I think it's very important for a trader to determine how they're going to manage situation in which the fundamental and technical is not in alignment. Okay, a lot of times traders would get stuck, right? When the fundamentals say one thing, the technical say one thing, and then they become like lost. They don't know what to do about it. Okay, so you need to be very clear. What's the weightage of importance you're going to give for technical, and what's the importance you're going to give for fundamental. Okay, there's no right or wrong. Really depends on individual preference, right? So for me, I would say it's about 70%. My decision comes from technical. Okay, the remaining 20 to 30% comes from other sources of analysis, right? Okay. Now on the technical analysis, this is a huge topic itself because there are just so many methods a trader can look in when they come into the charts, right? You have pure price action, basically looking at price movement, looking at patterns. Then you have the method on technical analysis using indicator based, right? And when you start to go into indicator, there are just so many indicators out there, right? So for me, I'm leaning more towards I would say price action basis, right? So we look at more on the pattern side of things instead of relying on indicator. Okay. So for me, again, I don't need to overcomplicate stuff. I just need two patterns, right? Why? Because if the market is not moving in the prevailing trend, then it's likely going to do what? It's likely going to reverse, right? If it's going to be in a range environment, then I don't trade, right? So all I need is to have a method to help me determine, are we going to continue the trend, or is the market likely going to reverse? Basically, I just need to find out that, right? Then I would have a direction that I can focus already, because if the market is likely going to continue its prevailing trend, I just follow the trend, okay, the direction of that. If the indication or the pattern is suggesting that, oh, the market is likely going to reverse, then of course I'll be trading and focusing on the opposite direction. Okay, so I want to also be able to break things down simpler for you so that you start to see the market in a slightly different lens, right? We don't want to overcomplicate stuff. Okay, we want to make things simpler, but at the process of simplifying stuff, we want to ensure that the essence of trading is still inside it, right? So that's something I want you to take away as well. Okay, so I only need two, right? One is a continuation pattern, one is a reversal pattern. Okay, so for me, the continuation pattern over here is what we call impulse correction, right? So it's a combination of two pieces in the market, right? And then a reversal pattern for me is basically an impulse plus a crawl, two pieces combining in the market, right? So exactly how does this look like? Let me show you in the wall. Okay, so this is an example of a continuation pattern. Okay, let me take out my brush to. Okay, so what we have over here is this is an impulse, right? What I mean by impulse is the market is moving in a very fast and strong momentum. Okay, so you can see this up move is fast, right? Relative to what? Relative to this piece over here, right? So that's what we call a correction piece. And why? Because it's taking a longer time to develop, okay, and it's not really coming down very fast, right? It's coming down in waves. It's coming down in slow movement, okay? And this one here, you can see the time it took to go up is relatively way faster than this duration here. Okay, so you start to compare, right? The time, the magnitude, as well as the development of time, right? So that's what we call impulse correction. Okay, now when we start to see impulse correction, okay, this suggests that there's a good chance the market would likely continue in its previous direction, right? So it works for upside, it works for downside. Okay, now I'll show you something that is on the chart. Okay. Now take a look at this, right? These are examples that have already been done, right? Its workout is completed, but it's a very good source of showing you exactly what I mean. Okay, so what you see over here, you can see the market went up relatively fast. It does a pullback up and down, but it's really not going anywhere. It's taking some time to develop. This piece is a trend continuation upside. Okay. So we get an upside here and then another continuation, right? Impulse correction combination. So what's it? It's a trend continuation pattern, upside. Okay. So whenever you see an impulse, you see a correction, there's a good possibility the market will likely continue up. Okay. If you see a down move followed by a correction, then there's a very good possibility the market will continue down. Okay. So that's the pattern that you want to be familiar with, right? Opposite direction here, you can see many examples in a simple chart, right? Impulse, correction, impulse, impulse, correction, impulse, right? Correction, impulse, right? So this obviously is not going to be 100% of the time, right? But it gives you that high probability pattern, right? I would say a good 70% of the time when you see a pattern like that you can recognize, the directional focus is more or less there. Okay, so that's what we call establishing your directional bias. Now, obviously, these are examples that have already been completed. Now, how do you apply this principle in the live market environment? Okay, you always focus on the right-hand side of the chart, right? So before the market actually developed, okay, what you see is something like that, right? So you always ask yourself this question. Okay, I always share with traders the tip, right? The tip here, TIP, is to ask yourself the question on how. How is price moving, fast or slow? Okay, so you start to look, right? This is, imagine this is where we are right now. You ask yourself, right, this entire development of price, how is it developing, fast or slow? Okay, and so you start to realize, right, it's actually pretty overlappy, right? You have like red candles, white candles, red candle, white candle, etc. Okay, and then prior to this, what do we have? We have like a very clear move to the upside. Okay, it takes very short time. The momentum is strong compared to this. So what is this pattern? Impulse correction. Okay, what is our directional bias? Very clear, upside. Can follow, right? So that's what the application is. Don't need to overcomplicate stuff. You expect the upside, your directional bias is bullish. You'll be focusing on buy trade only. Okay, so that's what we call direction, right? The first element of the framework. You establish the direction you're going to look out for. Okay, and of course, this is what happens in the market after that. Okay, now give you opposite direction, right? Same thing. Okay, we are here. Ask yourself this question: how is price developing? Up and down, very wavy. What's the previous move? Downside, fast. Okay, so what we have, impulse correction. What is the direction that we're likely going to be looking out for? Bearish. Okay, so again, keep things simple. We're in a bearish bias, the direction that we want to focus. We're only interested in looking for sell trade. We're not interested in the buy, right? And this is what happens after that. Okay, so that's how I determine the direction. Cool. Let me just very quickly jump into some examples of the charts. Right? Let me find some clear ones for you. Okay, we have a couple of it. Okay, now take a look at. Let me find the most obvious one first. Okay, probably can work off this year. Okay, so this is the current market on Aussie dollar, right? So now this is where the market price is. Okay, and you always ask yourself this question: how is price developing, fast or slow? And you start to realize, oh, we are going up and down, up and down. We're not really going anywhere in this entire piece, right? So that's definitely a slow move. It's a correction. And how did the market come here, right? It came from the top, it came down pretty close, pretty fast, right? And it's relatively shorter in terms of the time that it took to develop. So what's the pattern here we are seeing? Impulse correction. What is the direction that we're going to be focusing? Downside. Okay. So what this means is that when I look at the chart like that, I can almost immediately say I'm not interested in the buy. I'm only interested in getting involved in a sell trade. Okay, so that's what I mean by directional bias. Okay, we can scan through some charts, like I think gold here is going to be very popular as well. Okay, so you want to ask yourself, every time you open a chart, ask yourself like, what is this, right? Is it a clear pattern or is it not a clear pattern, right? So at times you may not get an answer, right? Because if things are not clear, then you don't want to be trading, right? That's where you don't have a directional bias and you just wait. Okay, so if you take a look at this here, okay, we haven't talked about the second pattern, right? But this here has a little bit of a development in either way, right? So if the market gives us a little bit more to the upside like that, then we have a clear correction, right? Impulse correction downside, right? But at the same time, this is a little bit early because the market can continue to do something like that. Okay, and this is going to be another pattern that we'll be talking about in a while. But this chart is an example where, this is a little bit too small. You just need to give it a little bit more time to develop. Okay, give you another example over here. Okay, so this is a Euro Canadian one. We haven't talked about this pattern, right? I'll come back on this. Let me go back to the slide first. Okay. Now this is another pattern, right? This is what we call a reversal pattern. Okay. So in this reversal pattern, you can see what we have is the first part is the same, right? We get an impulse move, but the second part is where you can see the difference, right? The market is continuing in its direction, but it's starting to slow down. Okay. Usually this means reversal, right? So it's telling you that, oh, the momentum is lacking, the energy to the upside is lacking, and you look for the reversal. Okay, so the opposite is same, right? It comes to slow down and then you look for a reversal. Okay, so this is a reversal pattern. We call this a crawl. Okay. Now I'll give you an example on how it looks like. Over here you can see upside very fast, it gets slow, and then what happened? It reversed, right? And you can see also the pattern coming in, right? This is impulse, this is correction, continuation, right? So you have this crawl here that gives you that initial early indication of a pattern reverse, of a potential trend reversal. It gave you that first impulse, it gives you a correction. This is a trend continuation. Okay. The other example is here. Okay, so you can see same thing, right? Came down fast, starts to slow down, reversal. Okay. So what does this mean to you, right? How do you apply this pattern in the future? Is again same thing. When you open up a chart, always ask yourself this question: how is price developing? Okay. So if you take a look at this chart here, what we have here, how has price been developing? Very choppy, which is corrective in nature. How is this correction developing? Slanting to the downside. Previously, what do we have? We have a fast, impulsive drop. And then after that, we get a corrective move. So what's the direction? Likely a potential reversal. Okay. So sometimes we're going to add in a little bit of a visual cue, like drawing lines, to help us frame the pattern better. Okay, to have the visualization of things, right? And this is where we look at the outside. Okay, because it's a reversal pattern, right? Same thing here, right? If you take a look at this, ask ourselves, how is price developing? Very, very choppy. Okay, how did it came to this area? Okay, from the low to this high, we have first push very fast, and then after that, very slow. Right? So this entire piece over here is a crawl, a potential reversal downside. So just now I wanted to show you on the Euro-Canadian side of things, right? This is where the pattern looks like in real life. Okay, so again, ask yourself, how is this developing? Slow, right? It's very, very choppy, and then it's landing down. How did the market come from here? This move. Right? So the thing about pattern recognition, right, is we are essentially finding the patterns in the market that tends to repeat itself and tends to give us some form of a reliability factor, right? What I mean by that is the pattern when we search out, okay, needs to have some form of a repeatability, which means it tends to repeat itself over and over again, okay, sufficiently so that you can capitalize on the opportunity. The other element is the reliability, right? Or in other words, people call it accuracy. Okay, so if a pattern essentially doesn't have a high probability of telling you something, right, consistently, then that's not a pattern you want to trade to, right? So this two pattern that I'm showing you is something that tends to repeat itself over and over again, and it has a high probability of doing what it usually does. Okay, so these are two patterns that you want to add it into your library, right? So what does Euro-Canadian pattern tell us? There's a good odds that this would reverse. So I'm not interested in the sell. I'm actually more interested in the buy, right? Because that's the direction that I'm looking at, right? That's the direction that the chart pattern is telling me. Okay, can follow so far, right? So over here, if you take a look at, some instruments like silver, okay, what do we have, right? You look at this here, this is so obvious coming down in the slow move. It's not going very fast. We have this move here. So am I looking to sell silver? Probably not. I'll be very much more interested in the upside. Can follow, right? Now, it doesn't always be 100%, right? I mean, if you take a look at this here, if I just replay it a little bit back, right? This is also a crawl, right? But of course, the market eventually did not reverse, right? It continued to drop. So again, it's not a 100% thing, but it's high probability. Okay, why? Because, if you just based on this time frame that we're looking at, right? We have one crawl here that works perfectly. This crawl didn't really bounce. This crawl here, if it bounced, then what we have at least 2 out of 3 times, right? I mean, 2 out of 3 is still a very small sample size. Okay, but what I'm sharing with you over here is the pattern tends to repeat and there's a high probability of working. Okay, but it's not 100%. Okay, so don't get me wrong, right? It's not something that you see a pattern and you go all in, right? That doesn't work out. Okay, so that's the two pattern, okay, that I wanted to share with you guys, right? Okay, so that's the establishment of direction. Okay, now once you have a clear sense of direction, then naturally the next step that you want to achieve is execution, right? When to get in, how to get in, what price to get in, when to get out, where to put your stop, etc. Okay, now this is where I call the term, right? I use the term setups. Okay, now setup is very important because as a trader, right, they're generally two types, right? One is what we call reacting to a trade, okay, and one is called that word slipped my mind. Okay, okay. There are generally two types of traders, right? What I want to say is one is reacting, right? So it's very reactive, okay. And then the other one is actually a responsive, okay, responsive approach. Now, it may sound, or you may think that they're actually more or less the same thing, but they're actually very, very different. Okay. Now, reaction or reactive trading is basically, oh, something happened, let's quickly take this. Okay, or oh, this happened, let's take this. This happened, let's exit the trade, right? It becomes very reactive. You're waiting for something to happen and then immediately you need to take action, right? When you're doing that, psychologically, it's going to be very, very difficult. Okay, your psyche is going to be impacted. You need to have a very strong psychology to really handle this kind of trading style. Okay, what's easier to handle is responsive. Okay, which means you actually plan out, oh, scenario A, scenario B, scenario C. Okay, if A happens, I'm going to do this. If B happens, I'm going to do this. If C happens, I'm going to do this, right? You can see the slight difference, right? This is responsive. You basically plan out the various scenarios in which the market could potentially develop, then you prepare for them. Reactive is, I don't care, you know, let's wait and see. Oh, and suddenly the market moves, right? Let's buy. So these are what I would say, try to avoid it because psychologically it's not going to be easy. Okay. So when we are talking about trade setups, right, you want to be very clear what are the criteria and the conditions for you to pull the trigger. Okay, and you need to be clear of the conditions before the market even develop. Okay, and that's what I mean by setup. Okay, now I'm going to give you some concrete example, right? Now, one of my setup over here is what we call a three-wave breakout, or okay, I'll use the example of a crop, okay, because that's the most common one that I'm using. Okay, this is the setup I most commonly use. Okay, now what I mean by setup is I need to be very clear. Okay, I want to see something like this, then I only start to put in my trade. Okay, and I need to be clear in the details as well, right? So I'll jump into some of the setups here to share you the details. But when I mean details, I'm referring to, okay, I need to see, you know, the crawl pattern having touched the bottom trend line 3 times. Then I'm only going to place a buy stop here. Okay, so waiting for the breakout, right? That's what I meant. Now, if today what I see is a move down, a move up, a move down, a move up, and you know, I only see this. Okay, this here and this pattern here is very different. It's likely going to develop into a setup that I want, but I need to be very clear, this here is not my setup. What I need is I need to give time for the market to develop further, to somehow develop a 3 touches, then only I have a complete setup. Okay, so that's literally the top process that I want you guys to have as well, right? You need to be clear what exactly you need the market to do before you pull the trigger. Okay, I hope that clarifies things, right? So I'll share with you the 3 setups, right? Obviously, I don't use all 3 of them a lot. Okay, you would have eventually a personal preference, right? Something that you love the most. Okay, so something to note as well, right? The more setups that you have in your library, I would say the better it is, but you also want to filter off and pick only the ones that you feel you like the most. Okay, now what I mean by that is, if today you only learn one setup, you don't have the power of choice. Okay, you literally can't choose because that's the only one you know. But if today you learn, let's say, 10 setups, okay, so you have 10 setups in your library, but you don't use all of them, right? Because if you use all of them, you'll be in a confused state, right? There's so many things ongoing. So within the 10, you then have the power to choose, all right, this I don't really like it, this one I love it, this one I would use at a very specific condition on a very specific market, okay? So you have the power choice, right? So the more setups you have, the more power you have in a way, right? But you don't use all of them. That's what I want you to, that's what I want to stress, right? So for me, I'm going to cover the 3 common setups that I use, right? This is the 3-wave extension, 3-wave breakout, and the crawl. Okay. So let's talk a little bit about the first one here first, right? Which is the 3-wave extension. Okay. So I use quite a bit of Fibonacci. I use the principle Elliott wave as well. Okay, so in Elliott wave principle, there's this principle that states that the market tends to move in 3. Okay, so just now we talked about the pattern of an impulse following that correction, right? Okay, and then we expect the market to continue its trend. Okay, so when we talk about the 3-wave extension, essentially is we see an impulse, okay, and as the market is developing correctively, okay, we want to expect at least a 3-wave move, right? So if this is one move, this is second move, we would expect it to come and form the third move. Okay, so that's what we call a 3-wave extension. Okay, and then after this, right, when we start to see, oh, the market seems to be developing the third move, what we do is we use some Fibonacci retracement and extension ratios to measure an equal length. Okay, so we measure the wave 1, and then we take it and map it over here to form an equal length. Okay, equal length essentially just means that this move here is equivalent to this move here, and then we expect the market to end off that and bounce higher. Okay, so this 3-wave extension essentially is your correction. Okay, and then we expect this to continue after it completes that. Okay, so in essence, that's the setup. Okay, so you see over here in this example, 1, 2, 3, 3 is developing. We're expecting it to come towards this area around 101.23.6 Fibonacci. Okay, that's equivalent to this equal length. Okay, and then after which we'll be looking for upside. Okay, so how is the trade developing, right? So again, we need to be very clear what we want to see from a market, right? So you want to see this continue to come down in a fairly slow environment, okay? And this is where our entry is. This is where our stop is. We want to see a nice little bounce, okay? So that's where you can see the entry based on 101.23 area. Okay, and then of course the stop is at a 1618 extension, and we need to be clear what we want to see. We want to see a clear impulsive bounce, right? Kind of like the market tag the area and then it shows some reaction. That's what we want, right? So once we enter those trades, we put in panel, we enter those trades, and the market starts to move in our direction. What do? Okay, we start to manage it, right? So again, we need to be very clear before the market actually happens. We need to know, oh, this happens, this is what we do, this happens, this is what we do, and things like that. That's what we call setup. Okay. So when you get a bounce and the market actually move 50% of this move, that's where we're going to trail and shift our stop. Okay, make it a risk-free trade, and then we expect this to continue higher. Okay, and that's what happens, right? If the market continues to break higher, that's great, right? However, again, we also need to plan, right? If let's say today the market gives us a 3-wave move, but didn't really come towards our area, and it just decides to bounce off impulsively, this is what we call a missed trade. Okay, so what I mean is we don't expect this to come back and enter, right? So this is something that we don't look at it anymore. We look at the next trade opportunity. Okay, so these are some examples on setups, right? So we have a buy side of a setup. We also naturally have a sell side of setup, right? So it's basically it's the same thing. It's just to flip it. Okay, so this is example of it. Okay, so let me bring you over to the chart and see if we have any setups as of now that looks like that, right? Okay, we have something over here potentially on the euro dollar, right? So just it may not be something that you want to take immediately. Okay, it's just again illustrating, right? So I'm just picking examples that I think is clear. Talk about it, right? Because the market is still developing. If you're aware, we have FOMC, ECB, BOE, SMB, news tomorrow. Did I miss out ECB as well, right? So there are very, very high impact news happening tomorrow. So definitely some of these trades here may not be the best to take. Okay, so I'm just using this as an example. Just want to very quickly remind everyone. Okay. Now, what I mean by three wave, you can see over here, right? This market came down. We're bouncing up once. This seems to be two. We're expecting what? The third move up. If we can get a three wave corrective move, then what do we have? Again, the pattern, impulse, correction, downside, right? So if you can get a corrective move here, what do we have? Downside. Okay. So over here, that's where you can use a little bit of fibs, right? So just pull this here. Okay, and we'll be looking at the 100 and 127. Sorry, 123, right? So of course this is still developing, right? Depending on where the market pulls back, we'll probably need to adjust this accordingly. But giving you just an example, rough estimation, this would be a potential three-wave move. Okay, so the expectation of this is, of course, the market comes down a little bit and it goes back up, right? So again, you can see the process of what I'm doing, right? This is called planning, right? Trade planning, and then I can only do this because I'm very clear what I want to see. The market hasn't really developed that, but I already start to plan how I want the market to develop in order for me to have something to trade. Okay, so this is what we call forecasting as well, right? Or what I meant by you need to be responsive, right? You need to know exactly what you want to see. Okay, so very quickly, just follow up on this, right? How do we sell? We sell it here. Our stops above 1618, and then our target. Again, to me, target is something that's very, very personal, right? You want to aim for how much profits. Really entirely up to you, right? But of course, if today your risk to reward ratio is like less than 1, then obviously that trade wouldn't make a lot of sense, right? But in terms of like how much you want to go for profit target, is really something up to an individual. Okay. But I think what's more important is to give you a framework of entry as well as where you put your stop, right? I think that's more important because target here you can aim for 1:1, 1:1.5, 1:2. You can go for home run trades. There's just so many ways to take profit. Okay, so that's one example, right? In terms of this, right? Giving you another example over here. Okay, it works on multiple time frames, right? So if you take a look at this, we have a very nice little three wave. Again, this one here, right? Just pull back a little bit. Okay. We have a very nice little three-wave move here, right? You can see this kind of came quite close, didn't really tag that, okay, and then of course the market can bounce, right? So again, it's not always to the point precision, but this is an example of again a very nice little three-wave move, and the market actually moved off. And see that, right? Okay, so this is an example of a three-wave extension setup. It works buy and sell. Okay, now the other entry setup that I have is called a three-wave breakout. It's slightly different from the extension entry, but the pattern we want is more or less the same. Okay, so what we want on this setup over here is the same thing, impulse, and then we wait for the three-wave to complete first. Okay, so the first one is we are anticipating the three-wave. This is we wait for the three-wave, right? So it's a little bit more on the conservative approach. Okay, so one is we are anticipating the third wave, we trade the third wave. One is we wait for the third wave to complete. Okay, so the breakout technique is wait for the third wave to complete. Okay, and how do we know the third wave is complete? When we see this low gets broken. Okay, so we have a move up, we have 1, 2, this is coming down, this low must be broken. Then yes, at this point in time, the third wave is completed. If you only have 1, 2, and this looks like this low hasn't been broken, it's not completed. Okay, so again, these are some conditions and criteria that we have to help us determine the setup. Okay, so once we have a three-wave completed, we're using a breakout setup, right? So that's where the buy stop potentially is, right? Now, obviously, this is still pretty wide. Okay, so as the market continues to develop, okay, we can start to shift our entry a little bit lower, right? Because this starts to come down like that. Then this becomes a minor high. That becomes our entry for the breakout. Okay, and then our stop is the same, right? So kind of reduces the risk as well. And follow, right? And then of course, what do we want to see? Ideally, we want the breakout to be impulsive. We want a breakout to have momentum. Okay, and then we just manage to trade accordingly. Okay. Now let me show you some examples if we can. Okay. Let's say I think recently. Okay, I will just use this. Okay. Now this here you can see, right? Again, what's the nature of this? Corrective in itself, right? What is the direction bias that we have outside? Okay. Now, do we have a tree wave completed from this high here? We kind of see 1, 2, 3, right? So we can't have that, right? This low has been broken as well. Great. Okay. Sometimes we just put in some annotation. Okay. Now you can also utilize the fit extension to kind of give you that, right? We can't have it, right? Can't tag it almost to the dot, right? So let's say we have this tree wave, right? So usually I like to use some channel lines to just visualize it. Okay. So where would be the entry right now, right? The breakout point will be there. The protective stop will be here. Okay. So I will just take the fib away, right? So of course, okay. Right now, based on what we have, the buy stop will be there. The stop loss will be there. The target will be out there. Now this looks pretty wide, right, for your stop loss. But again, what can potentially happen is this can start to go up. It starts to pull back a little bit. Okay, and then what we have is we have another minor low. Minor high, right? So our breakout will then be shift to the downside with you. Okay, so again, that's what we call a setup, right? A breakout setup. Okay, that's to the upside. Okay, sometimes smaller time frames may have something. Okay, let's just give you some more example. Okay, let me find one that is clear, you know. Good. Okay. Okay, I mean, recently the market may not give you a lot of clear setups, right? That's how it works, right? Yeah, okay, I think that's the best I can find, right? In terms of like roughly scrolling through, the Kiwi dollar will probably be the clearest example for now. Okay, so that's what we meant by three wave breakout. Okay, hopefully so far so good. Yeah. Then we have the sell side of things, right? Then lastly, what we have over here is a crawl breakout setup. Okay, so the crawl pattern is essentially trading the reversal, right? So just now the first two is trading the trend continuation. This is trading the reversal, right? So same thing, right? The principles, the processes, the criteria is more or less, it needs to be there. You need to be very clear what you want. Okay. So for crawl setup over here, what we need to see is essentially a 5-wave move. 1, 2, 3, 4, 5. So where the trend line tags 3 times, and then we'll look for the buy. The reversal, right? Basically a reversal. Okay. So this one is where we're going to use a breakout, right? So quite similar to the 3-wave breakout, it's just that the conditions and the criteria are different. Okay. So we're depending, and then ideally what we want an impulsive break. Okay. And that's the example. Okay, so let me just very quickly again bring you over to the charts, right? So recently we have the Euro CAD, right? So just want to cover this as well. Okay, what's the pattern over here? This is a crawl. Okay, now do we have a minimum 5-wave internal, right? We have, right? I think this is definitely very obvious. Okay, usually the guideline on the visual perspective is, do we have the price tagging the trend line at least 3 times, right? Because mathematically, if we have 3 touches on the bottom of the trend line, we have a 5-wave move internally, minimum. Okay. So in this case here, you can see, right, where would the potential breakout is. Okay. Of course, you can use this swing high. You can also shift this over here. Okay. So we have recently just broken out of this, right? But just want to show you this example of, you know, the crawl setup. Okay. Now, just now I mentioned a little bit about, sorry, did I mention gold? Silver. Okay. So just now we mentioned a little bit about silver here, right? Okay. So again, you know, if you take a look at this, again on a higher time frame perspective, do we have a setup, right? We have a crawl pattern, right? This is looking crawlish in nature, but we don't have a setup, right? Why? Because again, do we have a 5-wave inside? No. Okay. Now at best, what we have is a 1, a 2, a 3. Probably you want to wait for this and this. Okay. So again, do we put in an order now? No, right? Because we need to wait for the setup to come to us, right? You probably need to wait a little while. If this continue to do something like that, then yes, we have a buy stop, we have a stop loss here, wait for a breakout. Okay. So again, you know, the part here which I really want to stress is you need to be very clear on what is the setup that you want to trade. Okay, and you need to be clear in terms of what are the criteria and the conditions that the market needs to give you before you pull the trigger. Okay, yeah. So this is the cross setups, right? So again, you have the upside, you also have the downside, right? Now, very quickly, I'll put this comparison chart here as well to kind of highlight, you know, every setup would have its pros and cons. Okay, so again, every setup sometimes is a little bit more conservative, sometimes a little bit more aggressive in nature. Okay, you then also need to pick a setup that kind of fits into your style, right? Are you more of the aggressive style trader, or are you more conservative style? Okay, so for me, you know, you can see this is how I break it down. To me, the crawl breakout is definitely more aggressive because why? We're looking at a reversal, right? For reversal trade is naturally going to be a bit more aggressive because you are looking at the first U-turn. Okay, if you are doing the trend continuation, of course, it's a little bit more conservative, right? Because the market has already more or less proven to you that, you know, it's going in the direction. Okay. Some of the pros here, of course, you know, you have decent risk to reward ratio. Crawl breakout, you have a high risk to reward ratio. Why? Because you are looking at the turning point. Okay. Now, time frame wise, okay, how do we often use it? For me, the crawl, often I use it on the lower time frame. Okay, so this is something that we play around with as well, right? We don't only stick to one time frame. We rotate from higher time frame to lower time frame, and then ideally you want your setup to come at the lower time frame so that your risk to reward ratio is going to be better. Your risk can be smaller. Okay, right? So this is something to note as well, right? If today you have like a lot of different setups, you may want to put that into a table so that you kind of understand each setup strengths and weaknesses, and then identify which one fits you. Okay. Now, lastly, okay, what we want to do is also to add context to our trade. Okay, now that's the part where we talk about price, right? So we have direction, we have timing, and then we have price. Okay, context. So for me, context is also important, right? Because not all setups are the same. Not all setups carry equal weightage. Not all setups are equal in probability. Okay, so you may have, you know, think of questions like this before. Do you still want to buy if price is near resistance zone? Probably not, right? Or vice versa, do you want to sell if price is near support zone? Probably not. Okay, and there are certain principles that we use as guidelines as well, right? So like price tends to move in waves. Okay, what I mean by that is, you know, it tends to go in waves, it starts to come down in waves, it goes in waves. It never go in one direction all the time, right? Okay, so again, another way of saying it is it tends to pull back, right? Because when there's a pullback, it starts to form a wave. Okay, so that's the principle of Elliott wave as well. Okay, so knowing where price is at an extra layer of analysis, and that's what we mean by context, right? Context. Where is the pattern developing? Where is price right now? Okay, so what are some of the elements that I use to establish context, right? Again, over here you can see we combine one or more of this, right? So there are generally 4 of it. Okay, now what is wave count of 3 and 5, right? So this is the principle of Elliott wave. In the FX market, oftentimes we'll see waves in 3, right? So if the market is coming down, it forms 1, 2, 3. This is one set. Okay, so in the FX market, what it tends to do is it tends to do this: 1, 2, 3. 1, 2, 3, 1, 2, 3. Okay, and then from a larger scheme of things, actually, this you can see this is 1, 2, 3. Okay, because market works in fractal nature. Okay, now 5, of course, is your typical Elliott wave, right? 1, 2, 3, 4, 5. Okay, this often is in commodities and the stock market, but of course, sometimes in the FX market, we do see that 5 wave development as well. But I would say 80% of the time, we do see 3 waves. Okay. So that's what we meant in terms of wave expectation. Now, what does it mean? So the context over here is, if today you kind of see 1, 2, okay, and of course, if this market is coming down, right, so this is the bottom, you start to see 1 and you start to see a correction, you can actually expect to trade this up, right? Why? Because that will complete this set, okay? However, okay, in another context, if the market actually came down, okay, and it forms a 1 impulsive move, a correction over here, and then this starts to go up, right? And from here, it starts to form a small correction, okay? Now, this correction here versus this correction here is a different probability, right? Why? Because when you take a buy here, you are riding on this move. If you take a buy here, you may be completing this 3 wave already, right? So your upside may not be very attractive. So can follow, right? What I mean by context, not every setup is the same, okay? Same thing for a crawl, right? If today the market came down, okay, and it forms a push up here, and then this forms a crawl, okay, this crawl is not something that you expect it to go all the way down, right? Why? Because again, we expect the market to move in 3, okay? So let me, okay, I can't erase one, so I erase everything. So if the market came down and you form a crawl here, what's the expectation is this will probably just pull back and we expect one more push up. So if we see a crawl here, we will not be aggressive selling that because that's not our expectation, right? So that's what we use for wave count, right? So that's the context of things, right? I think support and resistance is quite clear, right? So this one we probably don't need to talk too much about it, right? So if today you see like a yearly resistance, you know, and then eventually at one point in time the market comes back, okay, and then it gets very, very close to that, you know, we see an impulse correction here, very close to a yearly resistance, then you don't want to be buying it, okay, because again it may not make sense, right? So that's what I meant, okay. Fit ratios, we use that quite a bit as well, right? Is the price approaching near a key support, a key Fibonacci area? If it is, again, then we'll be a little bit cautious, right? Right. So for example, you know, we have a move down and then it starts to bounce, right? So usually we'll take the Fib here and then we'll look out for the 50% and 618 Fibonacci. Okay. So if the market actually somehow do a impulse correction here, yes, then we'll be looking at buy, right? Because why? Again, we have a huge profit potential to the upside. However, if today the market came down and it starts to go up, okay, and of course, again, you know, it's getting close to that 50 and 618, and you start to see a pattern over here to look for a buy, you want to be cautious on this buy. Okay, so that's how we use the ratios. Okay. Last one here is the multi-time frame perspective, right? So this one is where I play around with 2 primary time frame, H1 and H4. Okay, H4 is what I call a higher time frame. H1 is what I call an execution time frame. Okay, H4 basically means if today we have a pattern entering a key support and resistance, you know, or key Fibonacci ratios, then I'll go down to the hourly to look for a trade. Okay, I'll show you some examples in the wall. Okay, but just want to highlight a little bit of all this here. Okay, so let me show you examples, right? Let's jump over to, okay, I'll come back to euro dollar over here, right, as an example. Okay, so what do we have, right, on euro dollar? Okay, so we have this impulsive drop. This seems to be starting to pull back. So our expectation, if this does a 3 wave move, right, again, the principle of 3, okay, and we do a lot of fibs, right? So if we kind of pull fibs from swing high to swing low, okay, the 50% and 618 will be the area of interest. Okay, so this is the context of 50 and 618, context of 3 wave, okay, pattern directional bias in terms of impulse correction, setup in terms of 1, 2, 3. You can see all those are coming together, right? So this is on a H4 chart. Okay, so this is my analysis time frame. This is the time frame I use to identify which is the area I want to pay attention to. Okay, which we identify, right? 50 and 620. Okay, now let's visualize a little bit on things, right? Let's visualize and say, okay, I'll help you by giving you some bar patterns. Okay, let's visualize and say, okay, price is indeed coming up and is getting close towards this area. Okay, something like getting close. Okay, not really there yet, but it's getting close. Okay, and this entire move is corrective still, right? Which everything aligns to what we want. Okay, so how I usually look for a setup, okay, is that we have a clear sense of direction. What's my direction? Downside. Okay, so if today I'm looking for a sell trade, right? What is the setup that allows me to sell? Okay, again, I'm very clear on the setup, right? I only have two setups to allow me to sell. One is I get a crawl, I take the breakout trade to the downside, right? The other one is I see an impulse and then I see a flag, right? I see correction here, then I take the sell trade. Okay, so I want to see that setup, right? And of course, I say multi-time frame. Okay, so what I'll do is I'll go down to the hourly and I want to see either of this setup developing around the zone. And follow the top process, right? Again, it's not complex because it's basically everything that we've covered so far, right? So what we want is we want to go down to the hourly, okay? And ideally in this zone, I want to see one crawl that will give me a setup to sell. Or, you know, if it doesn't give a crawl, what you can do is you can go up, come back down fast, and it forms a flag here. That's the setup, okay? And then we talk about the setup, right? You look for the breakout trade, the stop loss is above there, the target is down there. Or if this is a second setup, we can use the breakout as well. The stop loss is here, the target is down there, right? Can follow the top process, right? So again, why I say you need to be very clear of your setup is because in times like that, we can always be 1 or 2 steps ahead of the market, right? We can pre-plan what we want to see before the market even develops. Okay, and that's crucial because that's going to help you psychologically. Okay, so that's an example of the euro dollar side of things, right? I'll give you another one, right? So for example, euro Canadian. Okay, so this is actually on the 4-hour chart, right? We have this little crawl here. Okay, the crawl has completed everything. Okay, is this a decent area in terms of context to look for trade? Yes, right? So you can see 50% of this entire move. We are in a key zone on a high time frame. The context is great. Over here in terms of Elliott wave, we also have a 5-wave move development, which completes a cycle. So we do expect at least what, a 3-wave move to the upside, at least as a form of potential retracement, right? That's what our expectation is. Okay. So in terms of context, you know, looking for a buy trade here is pretty decent. Okay. Where can we expect this buy trade to potentially go towards? 50 and 618, right? So with all that said, right, then what we can do is we can go out to lower time frame. Okay, now if we did not manage to get involved, I mean, if today, you know, price has already moved, right? So we may not have got in at a breakout here. Okay, so what we can do now is we have this move up. This may be pulling back. Okay, so if we can get a crawl, sorry, a 3-wave correction, okay, that will give us a hourly buy setup, right? Okay, as a breakout trade. Okay, so if you look at this, the risk reward ratio is pretty close to 1:2, right? So going back on a H4, that looks something like that. Okay, so again, you can see the application of things, right? The whole thing, we put it together, actually comes from individual component, right? We talk about each of this throughout today's session. Okay, and then right now we're basically just putting all of them together to give a complete package, you know, in terms of like how we analyze, how we trade the market. Okay, so I hope so far so good. In terms of like this, right? Again, I wouldn't use the slide here to talk about it, but basically all this I've actually explained just now. Okay. Anyway, the slides I've actually passed to Ethan. If let's say IG markets are okay with it, you know, I'm open to even just forward all these slides to you guys for reference if you need to. Okay, so I just want to jump over here and then open up for Q&A in a while. Okay, so you can see basically when we start to put things together, right, we often ask ourselves this few questions, right? Do we have a clear sense of direction? If you don't, we move to the next asset, we move to the next chart, right? Because if you don't have a clear sense of direction, there's no way we're gonna start putting in more things to trade, right? Because the number one thing to do is to identify which direction to focus first. Okay, once you have a directional focus, then you need to then look up, do I have a setup? Okay, if I want to buy, do I have a buy setup? If I want to sell, do I have a sell setup? Okay, so if you don't, then you want to wait for the setup to come to you. Okay, and that's the part where you need to be very familiar in terms of what do you need from the market to give you that setup. Okay, so once you have your direction, once you have your setup, then you also need to cross check, you know, is this trade worth taking? Is the reward worth it? Is the effort to reward worth it, right? A lot of times we only look at how much potential money you can make, right? But if today you're going to stress yourself out to make that little bit of profit, then it's not worthwhile, okay? So you always want to balance the risk to reward ratio. At the same time, take a note of your mental capacity, right? As I mentioned, every time you take a trade, there is some mental part that you need to commit to, okay? And you may, because of a small profitable trade, end up losing another opportunity that will give you a big profit, and that's not what you want, okay? So the context perspective is really to give you that guidelines, okay? So there's 3 questions, right? Often give you that framework to guide you, all right? So I hope so far so good, okay? Let me very quickly, because we have about like 15 minutes, so let me very quickly take a look at some of the questions, okay? And do my best to answer as many questions as we can, right? So if you still have questions, because I see over here, I think we have like 3 questions, okay? If any of you still have questions, feel free to put it in, okay? Then I'll be able to answer them as well. Okay, so first question I see here is from Lai, right? So Lai actually asks, sometimes I gain confidence but suddenly change market direction and crush my confidence and profit anyway to avoid it. Okay, so I would say if today you are experiencing something like and you took a trade and then the trade is moving in your favor and then suddenly it just reverses, right? Okay, there are generally, again, there are a lot of possibility of how to work things out. Okay, but I would say if today you are facing that, I would say generally, right, my experience is there are 2 things that you can do to help to improve it. Okay, 1, manage and trail your stop, right, which means you do not want to end up giving away the entire profits back to the market. Okay, so that's 1, right, which is pretty easy to manage, right? Start to trail your stops, right? The other one is maybe you want to look into the framework on context, okay? Because maybe, again, as I mentioned, right, the market came down, there's a support, it bounced up, it comes back down, and you're looking to sell a trade here, okay? So in the short term, it may work out a little bit, but because we're already entering a key support zone, that sell trade may be short-lived, and then the market then bounce back up, okay? So you may experience some small little profits, and then after that, the market reverts, right? So context, the element of context may help you to look into some of these traits and see, how you can actually avoid them or, improve on it. Okay, so I think that's the 2 suggestions for you to actually work on. Okay, Victor here asks, do you think Bitcoin is showing a continuation pattern with a potential break to the upside? Let's see quickly on Bitcoin, right? Okay, now for me, I'm using Bitcoin futures chart, okay, simply because I think futures is the centralized data feed, right? Because if today we look at Bitcoin in various exchanges, the price feed can be quite different, right? So I actually standardize my analysis of Bitcoin by looking at the futures chart, okay? Now, I will look at the H4, right? Now, if you ask me what's my take on the H4, I would say short-term downside. Okay, short-term downside, longer-term upside, right? Why? Okay, because short-term, what do we get? We get an impulsive drop. Now, this is a little bit slow right now, but there's a good possibility this will go back up, okay? And when it starts to form this, we expect 1 more drop, right? Why? 3-wave expectation. We're using the context of 1, 2, 3. Okay, so what we have is our first move, right? So if we can get a correction here, if we can get a correction, right? The keyword is if, yeah? It's not like you want to just sell it. Okay, but the thing is, if you can get a correction here, okay, again, we use FIBs, right? So potentially around the 50 and 618, okay, then short term, we can expect a drop. Okay, how far can it drop? We can use another expectation called an equal leg, right? So if this drops here, okay, then we can measure an equal leg and we can expect something like that, right? So if it's going to be around the 50 and 618, then somewhere there. Okay. Now, once we get this in the short run, then what you realize is we have what? A 3-wave move, right? Then from there, we can then make an expectation that this will bounce back up. Okay. So of course, this is a little bit into the future, right? But you can see what we're doing here, as I mentioned, it's called forecasting. It's called trade planning, right? We are planning way ahead before the market to know if the market does this, how are we gonna respond to it, right? So we are no longer in a reactive state. Okay, we are always like way ahead, right? If the market does this, I'm gonna do this. If the market does that, I'm gonna do another thing, right? Yeah, so that's my take on BTC, right? At least from a 4-hour scale perspective. Okay. Okay, Jeffrey here asks, does this pattern applies to stocks or equities? The answer is yes, right? But there's just that slight difference simply because equities market has its own nature compared to the FX, right? But if you're interested, then you can let me know one equities. We can definitely look at that and apply it. Right? Is there any specific stocks that you guys are interested in? I can look at the chart and then work on one example to show you the principles behind it. Right. If not,
Yong, maybe we can look at the Tesla one. I think there's a lot of our clients trading Tesla.
Oh, okay. Tesla, yeah. Oh, okay. So I see. Yeah. Victor says, sorry, Max says Tesla. Okay. So the principle applies, right? Of course, just understand that if a stock is fundamentally strong, then it helps to generally already build that fundamental bias, right? It already built that directional bias on the upside, right? If a stock is fundamentally strong, okay. But technical wise, it works as well, right? So again, depending on the time frame you work on, because stocks are not 100%, are not 24 hours, we do see gaps, okay. So one very quick reference on gaps first, right? I would always suggest, if you can't visualize how to resolve the gaps, train yourself by changing it into a line chart, okay? And you start to realize that, oh, there's really no gaps, right? So basically, going back to candlestick, what does the gap means? It means that it's an impulsive move, right? So mentally, you want to fill it up with a line, okay? So this move to the downside is impulsive in nature, right? That's something I want to just talk about, because sometimes, you know, traders may not know how to kind of like look at gaps when they're doing the analysis, right? So overall, you can see the pattern, at least on the daily chart, right? This is on the daily chart. You can see that overall pattern is the same, right? What do we have? 1, 2, 3, impulse correction upside. 1, 2, 3, likely this will continue upside. Okay, so the principle, the way to analyze the chart is still the same. Okay, even in terms of like you look at fit ratios and things like that, this missed off a little bit. Okay, let me just double check. Is it in the log scale? Yeah, it's in log scale. Right, certain charts, again, you want to look at log scale, especially on some of the stocks that has an exponential growth, okay? Because if you don't look at the log scale, sometimes the proportion may be a little bit off, right, to analyze charts. Okay, so back to Tesla, right? So the direction bias right now on the daily scale is quite straightforward, it's upside. Okay, because we are looking at this impulse, we are looking at this 3-wave correction, and this 3-wave correction may have concluded with this low. Okay, and right now what we have is this is an impulsive move. This may start to do a pullback. Okay, so what I'll do is usually I'll just go down to the lower time frame. Okay, and we can use some fits to give us some reference point. Okay, 50 and 618. Again, start to plan out, right? How do we want this to come down, right? Ideally, we want this to come down correctively so that we have a combination of an impulse correction and we can then expect upside. Okay, let me then also put in some channel for visual references, right? So that's ideally what we want. Okay. So same thing, right? What we can play around with is multi-time frame. As the market starts to approach around the 50 and 618, which is about $223 to $216, you can even consider going down to the hourly and see if you can get a crawl. Okay, again, the slightly tricky part about stock market is it's not 24 hours. Okay, so even if you go down to the hourly, you may see some kind of a gaps and things like that. Okay, so my take is you may not get a very nice crawl entry, but what you can do for stock market is as this approaches here, you look for the breakout technique. Okay, so maybe you utilize something, it is a bit thin. utilize something like that, right? So you wait for the breakout of this. As the market approaches this, you put your stop just below that low, and the anticipation is it bounce and start to break out. Okay? So then you play around with higher time frame as your targets. Okay, let me just very quickly bring this to show it on the daily. Okay, so then what you can do, you can use your daily as your target, right? So again, depending on the horizon you're looking as well, right? Because if fundamentally you strongly believe in Tesla, you don't want to take everything there, right? Because if fundamentally you believe in Tesla, then you may take partial profits, but you always perhaps will want to put a little bit of a position to run for as far as it can, right? Because if fundamentally it's strong, then it will always break new high, right? That's the logic behind it, right? So the whole principle that we cover applies to stock market as well. Okay, it's just the visual aspect may have a little bit of a difference because of gaps, and oftentimes stocks has some fundamental driving force, right? So the fundamental kicks in a little bit more. Yeah. Good. I'll take maybe another 2 questions I see over here very quickly. So Lily asked about gold. Okay. So again, on the shorter term perspective on the H4 and gold, okay, if we can get a pullback, short term we may still see a little bit of downside, and then long term, fundamentally macro perspective, I'm bullish on gold. Okay, which means going into, you know, if the horizon is going into next year, second half of the period, which means June 2024 to maybe end of 2024, I strongly believe gold would be bullish. Okay, based on the primary factor that the Fed may start to pivot and start talking about cutting rates, so the dollar would drop in value if that happens. The second macro factor is the conversation about de-dollarization, right? The dominance of the dollar would start to drop, and that will also devalue the dollar, right? So these 2 things would causes the dollar to drop in value. Not 100%, but that's the probability, that's the forecast that I have. Okay, and gold right now is still the safest asset, right? So if the dollar starts to lose its dominance, money flow would start to pivot into something that is of a safer asset, right? So gold is still that. Okay, so that's the take on gold, right? Short term, if you can get a correction, we will expect one more drop, right? Why? Because the principle of 1, 2, 3. Okay, and of course this pullback is just simply correcting an upside, right? Okay, so that's the view on gold. Okay, last question very quickly before I pass it quickly back to Eden. From Joel, we have a question, right? When the high and low is broken, are you referring to price level going higher or lower than the previous level or the candlestick? Okay, I don't really look at candlestick close in terms of this approach. Okay, we are just looking at price breaking it. So the wick counts. Okay, the wick counts. But oftentimes it's not really that particular, because most of the time the break is quite clear one, right? It's not like it tags it a little bit. Yeah, but to be precise, okay, I'm looking at wick, right? So if let's say I think dollar yen would be having an example of that. Okay, let's say this one here, right? Okay, this example, okay. Does this constitute to a break? Yes. Okay, even though it's a little bit, right? That constitutes a break because basically that's the peak and it poke it through. Okay, so that's my take. Okay. The last one I see very quickly from Vincent is what's my take on WTI. I'm going to show you on this chart so that it's faster, right? The analysis is done. This is my take on WTI crude oil. Okay, so crude oil you can see is a commodity. So from any wave anticipation, we often look at potential 5 wave, right? So from this peak, 1, 2, 3, 4, 5, it's likely ending. Okay, so again, why I'm neutral? Because of context. This profit potential is not worth the sell. Is it a buy yet? No, because we don't have a pattern to tell us a buy. But if this starts to do a crawl, going into the key area, then yeah, we'll be looking for the buy trade from there on. Okay. Yeah, that's a very quick one. Just to very quickly update, right? So the key level we are looking here is around $65.75. Yeah. Good. Yeah. So I'll very quickly pass over the time to Ethan. We do not want to overrun and we'll respect everyone's time. Yeah, so I'll pass the time back to Ethan for now.